We didn't predict it would make a new high. We should have, frankly, because that's what happened in 2000. That's what happened in 2007. You went up and made the new teasing high. Only this new high was the trap. Okay, that second new high. I think that's where we are. Momentum says you're so broken that you got a real problem. Now, when we go in some of the other sectors, not the ones that the public is looking at. Well, even NVIDIA is not looking real good right now, but forget that. We go into the financial sector, which we know is key. You can't have any of the big banks have a sudden downside whoosh, okay. In fact, they all look technically very similar, meaning vulnerable. Whereas, yes, they've had a rally like the S&P, but they have a momentum structure right below their feet now in this new quarter, such that if you drop several percent from where you are right now in the banking sector, you're probably going to get some stories. Now, I don't mean failures, but something nasty coming out of the sector that few people are looking at. Also, Visa and MasterCard.
Something historic is in the process of developing in the precious metals market. Silver is on the brink of a more vertical trajectory than one could ever conceive, according to Michael Oliver, one of the world's foremost technical analysts. In the past few weeks, gold has rallied to its highest level since 2008, surpassing $4,300 per ounce. Silver followed, reaching a new multi-year high above $53 before experiencing a chaotic swing as traders competed to secure physical supply. Oliver asserts that this volatility is not arbitrary. This is the same behavior that has preceded every significant silver outburst in modern history. In this video, we will examine the reasons why Oliver is of the opinion that the silver-to-gold spread is indicating a once-in-a-generation event. The current state of the global metals markets and the implications for individuals who possess gold or silver. Because Oliver posits that silver does not rise progressively when this ratio is breached. It erupts.
Sectors, not the whole market. S&P, NASDAQ, yes, but there's some sectors that didn't, and important sectors. Leadership in the market has dwindled, meaning what's really going up and leading this thing is, it used to be the Mag 7, now it's the Mag 3. Okay. Same is true with various sectors. From a momentum perspective, what broke in January in terms of a chart of like quarterly momentum, what is that? Let me explain real quick. You plot each month's price bar, like everybody would on a price chart, but we oscillate it versus a 3-quarter moving average, which every quarter changes a bit because of the prior 3 quarters of action. And you're oscillating against a mean that is determined by the action of that market. In terms of with strong up, you'd have a strong rise in the 3-quarter. If you had strong down, you'd get a strong drop, et cetera. So your oscillator zero line will change quarter by quarter based on where that average is. When you plot the momentum of the bar action in relation to that mean, you get a different picture than when you look at the monthly price chart of the S&P. Totally different picture. In fact, when we dropped in January, we broke a 2-year uptrend channel on momentum. You cannot see it on the price chart, but for momentum, it said your backbone is broken. Now, does that mean you have to just keep going down? No. The same thing happened in 2000. We got bearish in January of that year. We had a drop into February, March. Then it went back up, made a new high. Again, we're talking .com top.
Yeah.
And it labored the whole year. It was a laborious top. The same thing happened in 2007. Made a high in like April, May, had a sharp drop, came back up, made a higher high, took out not only the high that occurred early in 2007, but the same precise high at 1550 on the S&P had occurred in 2000. So if you're looking only at a price chart, you should be impressed because we went to 1575. We broke out through the dual highs. So a price guy would say, oh, triple top breakout. We're starting. Momentum said, no, you're a dog. It's no good. The Fed created that rally, by the way. They cut rates.
Of course.
We rolled over. But both tops were laborious. Both tops involved, once you broke momentum, it still involved a higher high in price that teased everybody. I think that's what we've just seen. A teasing new high in, again, some sectors, some indexes. And when you roll over again, and even from a price chart perspective, if you go back below the January high in the S&P, that was 61.47. Right now we're trading in the 6,500s. So you drop back below that high, and even the price guys are going to say, well, I thought we had a launch here.
Yeah.
It's failing.
Are you seeing some similarities between, 2000, 2007, Michael, where retail is just going all in on this market? Yeah. I mean, it's more breaking all records.
So. Oh, yeah. No, I hear that from various people in various banks and brokerage firms affiliated with it. They've never seen customer margin so high. And the leverage involved, the excitement, the percent of commitment of the investor out of their retirement account that's in up to here.
Yeah.
No, it's a fever. And that makes sense because quite often at the end of these beasts, you do get that fever where, golly, I wasn't there before. I'm going to be there now, and you're maxed up. And when it rolls over, emotion comes into play. That's a key factor, I think, going forward in a lot of markets is when you get emotion involved. Right now, think about it. Middle class person with a retirement account. The only thing you're smiling about is what? Your 401k. Hey, it's up, on the year.
Yeah.
Not up much, but it's up, So you're smiling. If you take that away from them, like, 2-3 months, suddenly there's no gain. And the year's almost over, getting late in the year here, have no gain for the year. And meanwhile, your buddy down the street bought gold a year ago and he's smiling like crazy and you didn't believe him, Okay. A lot of things are happening here. Okay.
Yeah, we'll get into gold and silver in a minute. I can't wait to talk about that. But so you're actually forecasting a continued decline and for the S&P to actually go negative by the end of
I'm looking
25?
for a bear market. And I'm not going to say how low, how long. History shows that bear markets last usually about 2.5, 3 years. 29, mid-1970s. .com was a 2-year drop, basically. Yeah. S&P went down 50% during that time, but the NASDAQ 100, which represented the internet, down 82%, a total wipeout. 2007 to 9, again, 2.5-year phenomenon. So, we might say, well, 2.5 years is normal, but dimension isn't. It's hard to say, particularly when you acknowledge that this bubble is bigger than any we've ever seen.
Yeah, definitely longer.
Yeah. Mm-hmm.
What could change your mind, Michael, if we go to new all-time highs, or is the price?
No, the price is not the key. It would take a miracle to get momentum to agree and say, okay, I broke, but now I'm healed and I'm going up. When you look at a current price of the S&P, you had that break in April. And by the way, we predicted a bounce, quote, what we call a bounce low at 4,800. It stopped right in front of 4,800 and turned. Okay. We didn't predict it would make a new high. We should have, frankly, because that's what happened in 2000. That's what happened in 2007. You went up and made the new teasing high. Only this new high was the trap. Okay. That second new high. I think that's where we are. Momentum says you're so broken that, you got a real problem. Now, when we go in some of the other sectors, not the ones that the public is looking at, well, even NVIDIA is not looking real good right now, but forget that. We go into the financial sector, which we know is key. You can't have any of the big banks have a sudden downside whoosh, okay. In fact, they all look technically very similar, meaning vulnerable. Whereas, yes, they've had a rally like the S&P, but they have a momentum structure right below their feet now in this new quarter, such that if you drop several percent from where you are right now in the banking sector, you're probably going to get some stories. Now, I don't mean failures, but something nasty coming out of the sector that few people are looking at. Also, Visa and MasterCard. We all know about consumer credit being maxed out, so forth. When you look at a chart of Visa and MasterCard, you say, hey, there's no problem, man. No problem. Well, either one's right or one's wrong, okay? And quite often price is illusory at blow-off peaks.
Yeah.
Visa and MasterCard are dancing literally 1% above levels that if they break during this quarter could create a real whoosh on the downside. The kind of thing that suddenly shifts attention to an area people aren't looking at, an area you can't ignore.
You mean from a technical standpoint, Michael, like just their valuation?
No, not the fundamentals. We don't get into that. we're looking only at the long-term technicals, not just the price. Price is secondary because often it's illusory at the top and it's illusory at the bottom. In other words, the bottom may look like heck and the momentum says, no, I'm okay. Same at the top. Price may look good. Momentum says, no, you're broken. Okay. So we're at that situation now. And I think the surprise effect, therefore, hence the emotion that come in, is when something happens in an arena that is not the one you're looking at. Yeah. You get gut kicked from the side.
Yeah.
Okay.
Michael Oliver's analysis is predicated on a single, deceptively straightforward chart. The silver to gold spread, which is a percentage representation of the ratio of silver to gold. The spread reached 1.5% in 2020. Silver has consistently underperformed gold since that time, with a recent decline below 1%. To provide context, the historical average is approximately 2%, which indicates that silver is currently trading at approximately half of its long-term relative value. Oliver refers to this as a grand mistake, a type of mispricing that markets will only tolerate until momentum is lost. His research indicates that a critical escape line is located at approximately 1.31%. That marks the starting point of an aggressive catch-up move, as opposed to years of silver lagging gold. He is of the opinion that silver will accelerate toward a minimum of 2% of gold's price, and potentially much higher, once the ratio closes above that level on his long-term momentum models. This is significant for the following reasons. A silver price of $80 is implied by a 2% ratio, even if gold remains constant at approximately $4,000. However, Oliver's more extensive momentum research indicates that gold could potentially double in value, reaching $8,000 per ounce during the subsequent phase of the cycle. If that were the case, silver would reach $160 as a result of a standard 2% relationship. And if it exceeds its current level, as it has in previous bull runs, we may be in for a price of $200 or more. He reminds the audience that this pattern has occurred on two separate occasions. In 1979, the silver-gold spread breached its resistance, causing silver to surge from $5 to $50 in a mere 6 months. The exact same configuration was revisited in 2010. By April 2011, silver had risen from $20 to $50 as a result of the spread. In both instances, gold experienced an increase. However, silver's performance was significantly superior after the spread verified the trend. Oliver draws a comparison between this and the experience of base metals such as copper and lead, which traded in a stable manner for decades before experiencing an abrupt threefold increase in price, which remained unattainable. He is of the opinion that silver is on the brink of a similar re-rating, which will not be a transient surge, but a new reality that has been influenced by years of monetary distortion and the global debt bubble. Despite the fact that inflation has caused nearly every commodity, including beef, copper, and housing, to adjust upward, silver continues to be anchored near its 1980 price highs. Oliver refers to it as the most mispriced asset on Earth for this reason. He contends that silver's monetary identity will re-emerge as governments encounter renewed debt crises and central banks discreetly contemplate partial gold backing for trade settlement. Upon coming to this revelation, he declares, "You will not climb, you will leap." Oliver is not interested in pursuing short-term transactions. It pertains to the identification of a structural transition. He anticipates a rapid, parabolic 6-month period once silver's momentum has been established. The same type of vertical phase that terminated every significant metals bull market in modern history.
This chart shows a logarithmic scale, a ratio scale chart of gold going back to 2015, when 1975, excuse me, when the federal government allowed us to own gold again. Okay.
Yeah.
That was very nice of them. Anyway, we've had two major bull markets in that 50-year span, with external conditions that are nowhere near the dynamite conditions we've got in terms of factors that could drive gold. Both were 8-fold moves in price, from bear low to bull high. no matter what the price, the different duration trends. One was about 3 years, one was at 10, okay? But the moves were the same, eightfold. Our bear market low, last one was $1,046, $1,050 in 2015. Okay, we're only halfway the dimension of the upside of those two prior bull moves. You can see it on the log scale chart at the top, which is the gold chart. If we were to match those two moves, just don't say we're going to do it again, okay, good, 8,000 plus gold. Okay, now that's just compared to the old bull market peaks. Now, it may not stop there because these factors we're talking about are horrendous, especially government debt, not just here, but Japan, elsewhere. Yeah. That game is yet to explode in terms of its real world consequences. My own personal assessment and portfolio is emphasis on silver now. Okay. Silver moves with gold, but it sometimes lags, sometimes outperforms. Usually it lags, okay? Now, this year it hasn't. It's actually up more year to date than gold is, okay, by a couple digits, okay? So it's significant this year. But historically, it's still very low relative to gold. Like silver's trading at 1.125% the price of gold right now.
We do 80 to 1? Is it still 70
no, we don't do it that way. We divide an ounce of silver into an ounce of gold, express it as a percent. And if you go back over that 50-year span of time, we don't show it here, but silver in 21 of those 50 years that we've had has at least been 2% of the price of an ounce of gold, minimum. And in bull trends, like 79 to 80, or we're in a bull trend now, right? Okay. Yeah. Or in 2010 and 11, silver was 3% or more the price of gold. So right now at 1.125, silver is very cheap relative to gold. But it's technicals of that spread relationship. And we study it, week by week, month by month, and we run momentum of the spread.
The warning issued by Michael Oliver to investors is unequivocal. Monitor the ratio rather than the headlines. The tripwire is the silver to gold spread at 1.31%. The vertical movement commences upon its breaking, and it will not wait for any latecomers. Therefore, I would like to pose the following inquiry to you. Are you of the opinion that silver remains the most undervalued asset in the world? And will you be positioned prior to the breakout? Or will you be pursuing it after it has already reached verticality? Please inform me in the remarks section. Your perspective would be greatly appreciated. If this analysis has facilitated your comprehension of the situation, please click the like icon, share it with a fellow metals investor, and subscribe to receive weekly insights as this historic setup continues to unfold. This is more than just another rally. It may involve the real-time revaluation of real money. Continue to monitor and remain vigilant.